Hi. Hi, everybody. Welcome back to Equity Live. Alex, Natasha, we have Marianne here. Grace, of course, our fine producer for the day is here as well. We're going to talk through the script quickly, which is what we do every week. You just don't usually hear it. And then we're going to do a show. So thank you for coming out. Glad you're here. And now you get to watch behind the scenes. Grace, please.
Yeah, just a couple of things to start off with. The sort of map for the day is at the top. I feel like the deals of the week are pretty clear. Again, just to say, I love it when there's like the questions and sort of probing, like, why is this the deal of the week? Why is this one unique and special and interesting and good? I think that format is working really well. Mm-hmm. And I see that there are a couple notes on there. Just before I move to the themes, is there anything that y'all want to bring up specifically about the deals of the week, or do we feel good?
I had one note, which is AngelList and what financing round that they led is still unclear. Basically, like, some say that it's their first institutional round since they spun out. Others say it's the Series B. One person says it's the Series C. So I think that, like, I guess I want to clarify that off the top as one confusion / clarification that's still yet to have a perfect answer. Yeah. And then also, I do this all the time, but it's not AngelList anymore. It's AngelList Venture. AngelList Venture is the one that raised money. AngelList no longer exists in the same way. It's kind of like the holding company behind everything. So I don't know. We need to, like, I don't think anyone really cares, but AngelList Venture. Yeah. Call it that.
That's super helpful.
Okay. Is it though, Grace?
Is it super helpful?
Clarification, but it's not a helpful thing from them.
No, it's like definitely very confusing.
Yeah, it is confusing, but it is helpful to know, like, within the scope of the this is and also that it's like unclear what round it is interesting to me, but
classic.
It's a confusing company, but we'll talk about it. But that was my only note.
Cool.
And then I really liked the Mara and Public story. Public, is that the one that was like all about social, Alex? Like Robinhood, but more social?
No, that's Public and Otis.
Yeah.
Oh, I think you're talking about Mara. Yeah. So Public is the community focused one. They bought an alternative fractionalized asset platform. Cool. Marianne wants to talk about what that means. We'll dive into the mechanics and why I think it's cool. I'll try to make the pitch. If it's boring, you can just boo and I'll cut it short.
I want to make sure it's the same Public I was thinking of, but it is. So
yeah, sorry, public.com, the app is the company. Yeah.
Cool.
Cool.
Awesome. And then for the themes, I feel like it was pretty clear laying out the steps of each conversation. Thebetter.com, I'm excited to dive into and hear a little bit of the background and chronology and what is happening next. I thought it was particularly interesting, just like also what Glean AI does, which is like saving, saving money that could potentially go towards people's salaries. And I was curious, I left a little note there, but I see that you answered it, Marianne, which is helpful. There's an interesting connection there. Theme 2 feels pretty clear to me, getting to that question at the end about why it's possible to raise a round, but not possible to SPAC in the market.
Oh, yeah.
And then on the third theme, just a quick reminder, the interesting part to me and to us, based on our conversation last time, is that there is international interest in these early stage African startups.
Yes.
So I just want to mention that as like the focus and direction of the conversation. YC is an interesting indicator and data point of that, but it's a larger international interest.
Yep.
Perfect.
That all fits. I'm just going to say this because this is for us, not for the people listening, but like, it turns out wearing a blazer inside sucks.
Oh, do you want to not wear the blazer?
Take it off, Alex, if you'll be more comfortable.
I'm going to tough it out because I'm only wearing a tank top. And that's probably slightly too casual. But if it happens, I'm just dying. So that's, oh shit.
Good,
sorry. Welcome to live production, everybody. Who wants to do a show?
Let's do a show.
Do it.
Are you ready?
Wait,
Feeling good?
We have to wait a minute. I'm sorry. I did that early. It's not quite time.
Oh, no, that's okay. We can do our pre-show deep breathing exercises, all reminders right. about the raffles, reminders about the Q&A at the end for our intro and outro. 1 ticket, all good things. All right.
All good things. Okay.
Let's take a deep breath in and out. I'll put the timing in the chat.
Perfect.
In 3, 2, 1.
Hello and welcome back to Equity, a podcast about the business of startups where we unpack the numbers and the nuance behind the headlines. My name is Alex and we are live. We are on Hopin. We are on Twitter Spaces. We may even be on YouTube. Who knows? But I'm here with my friends because it is a Thursday recording for a Friday show. And that means I have Natasha Mascarenas here. Natasha, hello.
Hello. I have a mimosa and cardamom candle going right now. So like that's the energy I'm bringing to today's live show.
I really was hoping you were going to stop after a mimosa and just have a mimosa on the show because that would be aggressive for a Thursday morning, but I'd be here for it. Marianne, do you have a cocktail themed candle as well?
Nope, just my homemade latte.
Hey, you got your coffee machine back. I feel like the listeners want to know. So you're back.
Of course, like immediately I had one.
Yeah. Marianne might be the only person in the world who consumes more espresso per day than I do. And I think she's doing the world's coffee industry a service. But quickly, guys, we're going to talk about the show. But first, TechCrunch apparently has some South by Southwest tickets. So if you are on the Hopin, you have been entered into a raffle automatically to get one, and we will announce who gets it at the end. This is a thing we're doing apparently for a little bit because it's South by Southwest time. We're doing panels, and if you want to go, we have maybe a ticket for you.
Also, Marianne is going to be there. So Marianne, are you going to like say hi to people in person?
You know, honestly, it falls during my kids' spring break every single year. So next year I will be busy and out of town, hopefully for most of it. But today I will be there interviewing Alex Mashinsky at 2:30 Central Time. Great Daily House.
Go ask for Marianne's autograph.
No. Marianne loves to be accosted in public. It's her favorite thing. Okay, so what is on the show today, guys? We're talking about AngelList Venture and some capital there. We're talking about Mara, we're talking about public buying Otis. Then we're going to riff into the Better.com situation because it is yet again back on our radar due to more missteps, you might want to say. Then we have notes on Acorns and Kin Insurance, a couple of consumer-focused fintechs. What's going on with the SPAC market and why are they not public yet? Then we're going to talk about African VC and we're going to wrap with some Q&A. So if you have stuff you want us to kind of like dive into, if you have questions about how I turned out to be so handsome, well, you can drop those into the Hopin chat and we will get to them at the end. Presuming that we don't burn through all of our time with our usual yammerings. So, let's start. Natasha, you're up first because AngelList Venture has made some news.
Yes. So for people who haven't been tracking AngelList as neurotically as I have, you may have missed that AngelList used to be a company that people really knew and resonated with. It actually spun out its 3 divisions into separate companies, AngelList Venture being one of them in 2020. And that part of the company, which is probably the one that you've heard of most recently, it started rolling funds, helps with roll up vehicles and a bunch of other stuff, has raised its first institutional round since spinning out. So they announced that they have raised a 100 million Series B with an asterisk. We don't know what series it is. They've raised a $100 million round led by Tiger and Accomplice at a $4 billion valuation. They're also opening up a community round. To me, this was the tension I have been bugging AngelList about since I started covering them, I guess 2 years ago, of you guys are trying to unbundle venture, rebundle founder services. Why are you so allergic to venture capital? And until this week, they basically were. So things have changed and I'm catching up now to see what the deal is with AngelList.
Yeah, I have a quick question. If this is their first institutional round and potentially their Series B, from whom did they raise prior to this?
It's a great question and one that I think they're still figuring out the answer to. So stay tuned for that.
That is so ridiculous. I just want to point out the hilarity of us not knowing what a $100 million round is, because a $100 million round back in the day wasn't kind of an A, B, or C round. That was an IPO. Right. That was the kind of money you would raise when you went public, when you graduated. And now we're trying to figure out if it might actually be an earlier stage round than a B, which is just to me indicative of where the market is. But a small data point, if you raise $100 million at a $4 billion valuation, you have sold, I think, is it 2.5% of your company? That's not a lot of dilution for 9 figures of capital. And it just goes to show how, yes, people talk about there being a slowdown in venture this year, but kind of, Natasha, this round it feels very 2021 to me.
Yeah, definitely. It feels very 2021. And I do think like the fact that they raised in the current environment is emblematic in and of itself. Like we all have been talking about the late stage markets quieting down, not being a thing. And now the fact that AngelList, after never raising capital, is noteworthy. I will say that the way they plan to use the venture capital is what we should all be thinking about and looking at going forward. When I talked to their CEO, Avlet Coley, I guess a month ago now, and asked him, are you ever going to raise? And he said no, because he said that they don't need money to hire. They don't want to hire, and they don't really necessarily believe in taking on venture to grow in the way that venture traditionally helps companies grow. And so when we talked again this week, he said nothing changed, but what I'm reading is like he's viewing it more as like Tiger is getting a portion of AngelList's equity to really cement a relationship between the most active startup investor and institutional partner that they could have out there, and them who do at some point are really going to need a venture fund to help bring more assets under management to their platform, but also continue adding validity to what they're doing.
Yeah.
Is Tiger investing in AngelList Ventures so that AngelList Ventures can back very early stage startups, which is what Tiger is also focused on, but maybe AngelList Ventures at an even earlier stage, or am I confused?
I think so. Tiger announced this week that it is doing actually Tiger didn't announce, the information broke a story that Tiger is creating a $1 billion fund of funds in which it will back emerging fund managers. And this news came out the day after of AngelList taking some of that money. So I'm viewing it as like, yes, AngelList got the Tiger stamp of approval, but Tiger has a great deal here. They just got a window into a really active pre-seed and seed database of startups raising, startups hiring. So I think that like Tiger is just using this as yet another data point. The same way we've seen a bunch of funds back other funds in order for competitive intelligence.
Yeah. There's too much money. Tiger has too much money. The fact that they put together $1 billion fund of funds is indicative of how much money there was sloshing around. Fund of funds to me is when you ran out of ideas and you think, you know what we should do is go and put some money into people who have ideas so they can put money into other ideas. So that way, when the returns come in, it'll trickle up.
Right.
It bores me. But I will say, Natasha, we did also cover the Lolita Taub new, is it Ganas Ventures this week? And I think it's important to note that we do cover some funds when they do kind of come together.
Totally. I think that Lolita's always stood out to me as being someone who like actually is like giving us data points on how community can lead to impact in venture. She has created so many tools and has, both in high moments and low moments for her shown the power of community in helping her become a now in charge of her own fund. So her new fund, I wrote about this week, they're raising a $10 million fund. I think they've closed 1 million so far. And I guess connecting the dots between Lolita and AngelList, other than the fact that she's going to be raising a community round from AngelList, my head is broken.
Who else?
I know. I mean, it's all I'm thinking is it wasn't a great time to be an emerging fund manager if you asked me a week ago, because LPs were starting to get worried and why don't we just put money into more proven out investors? Now we're seeing those proven out investors create fund of funds. So it's a good time to be an emerging fund manager again.
Nesting dolls of money is how it feels like. We're just shuffling around the same dollars. Maybe that's good. Like I'm like, to be clear, is it good to see Lolita raise a fund? Good to see more Latin American focused funds, more women led funds, like huzzah. But like, I don't know. At some point, it all gets a little bit kind of fungible to me. Like whenever a new major firm announces a $2 billion vehicle, I'm like, great.
Yeah.
And moving on. Because they're all the same now. Like, Sequoia has $50 billion in the new fund. Cool. And I just don't care.
It's just less exciting than it used to be.
Marianne, your deal of the week was a lot more, I guess, down to earth. And I guess like accessible to someone who isn't necessarily interested in like the deep dynamics of venture. So tell us about Mara.
Yeah, I mean, I really got into this story for a few different reasons, and you guys can probably relate to this. Like sometimes, I wrote a ton of interesting articles this week, in my opinion, like interesting companies is what I mean. But this one just really stood out to me, like what they're trying to do, who's doing it, how they're doing it, all of it was just really compelling. So the company is called Mara, which is short for maravilhoso in Portuguese, which means marvelous. And one of the co-founders also co-founded 99, which was the first Brazilian unicorn, which is think it was like a ride hailing, kind of like Uber for Latin America. So this venture, this company, what they're trying to do is help people who live in the outskirts of like larger cities in Brazil get access to groceries and these kinds of products at wholesale prices, and making it more accessible to them, making the products more affordable to them. So I love the mission, first of all, because any company that's trying to help people who don't traditionally have access to things that others more privileged do makes me happy, because I think it's ridiculously unfair that people who live like in the core center of Sao Paulo pay less for groceries than the people who live in the outskirts who can't afford to pay so much for them. So that's what this company is trying to solve for. So it's teaming up with like merchants that already exist in certain pockets, neighborhoods, and those merchants will act as like a delivery point where the groceries will be delivered there. The people can order online from a website. They're not required to download an app, which is important because in Brazil, it's not so easy. It costs a lot of money to pay for storage. So they don't want to require that. They want to make it easy for people to just go on a website, order what they want, go pick it up, and pay less for it. It helps the merchants. They get foot traffic. They get a cut of the sales. And the fact that like this is just going to help a population that really needs it just stood out to me.
I love all of this, to be totally clear. I'm just curious about the margins for the company itself, because if you're going to do wholesale prices and you're going to do this kind of distribution model, that's a terrible sentence. I wouldn't write that one down, but I said it, what can you do? How much is left for the company itself to actually kind of command for itself? Because this won't be cheap. There's a lot of moving parts here.
I thought about that. But the good thing is that Ariel, the co-founder, had a lot of experience in growing 99. So they're taking a similar model. They're going to take each region that they're working on and really focus on making that successful. I think he told me gross margin break even before they even move on to another area, another city. So they're growing in a very measured way. They're not operating at a growth at all cost mentality, which is very refreshing. And I think his experience, along with his co-founder, who also worked at 99, will really help them grow. They raised, $6 million in a round co-led by Canary and Caffeinated Capital and a bunch of other angels and investors. So, this is really interesting. And I think if they could grow this, not just in Brazil, but other regions of Latin America, it could be huge.
Yeah.
I think them saying that they aren't ever going to move on to another kind of geography until they hit gross margin break even, is going to be really fun to track, because then every time they expand, we actually know that there's power behind the expansion, unless they change their mind and they don't,
or they get close.
Yeah. Right. I mean, there's so many ways to justify it. And I think venture capital incentives always stress me out a little bit, because I'm like, yes, you can have the best of intentions, but is it going to make you stop? But I mean, I will say food delivery has proven time and time and time again that it is so hard to do in a way that's profitable, that maybe that's giving them more patience and grace to grow in this way than a company who started out a few years ago.
Yeah, I'll be curious to see if the model of having distribution points that they bring stuff to and then you pick up from will actually change that economic structure, Natasha. Because if you don't have the person in the car making one-off deliveries, does that change the overall economics? I mean, it sounds like it should, but I mean, of course, as we know, on the ground, things are often very different than how they seem from paper.
I mean, they referenced that. They said right now, last mile delivery is a very tough space to be in, especially where gas prices are going up and things like that. So I feel like, this model, has potential, but we'll have to see how it plays out. But I was super excited by what they're trying to do. And I'll definitely be paying attention in the future.
I want to loop back to Natasha's point about venture incentives, or venture economics. And if you wanted a kind of a metaphor about this, think of you're on a treadmill, and then the treadmill keeps going faster and faster and faster. That is essentially venture demands. You have to keep growing. You have to grow more each year in dollar terms to keep that growth rate up as you kind of scale the business. And that's a tough treadmill, or I don't know what the slippy bit to be on. And so it's tough. It's difficult.
Yeah, the treadmill starts yelling at you at one point and then throws you off even. And
then there's 3 nerds with laptops by taking notes on how you're running and talking shit about you on the site. That's us in this metaphor.
Okay, that should actually be our new like logo. We need to like get some art going.
I love this idea.
Can I talk about Public? I'm really excited about this one.
Please
Yes.
do.
I feel like I loved Otis's tagline, stock market for culture. So why is Public getting into that?
Yeah. Okay. So go back in time, 2020, 2021, savings and investing boom amongst consumers. A lot of folks ended up with extra cash. They kind of put it to work. They were bored. So they did a lot of trading. Public grew kind of alongside Robinhood with a different focus. Robinhood was options trading and payment for order flow incomes. Public kind of diverged and said, we're not going to do that. We're going to focus on community and we're going to kind of put off making money to the future. Fair enough. It's a cool to take a different kind of take on the same market, and we get to see kind of a natural experiment in the world. So time passes, Public has scaled to 3 million users, and they announced this week they bought Otis. Otis is a startup that raised, I think it was like $16.5 million, somewhere in there. And what Otis does is that it fractionalizes alternative assets and then lets people buy and trade pieces of them. And Marianne, I know you wanted to talk about this. So let me pause, let you ask a question, and I'll try to clarify what that means.
Thank you. I'm just wondering, like, if everybody listening understands exactly what fractionalize means, like if you can help break that down a little bit.
Yeah. So a company issues, let's say, shares of stock. Let's say there's 1 million of those, and the company grows over time, and suddenly each share of stock is worth $2,000. Well, hell, if you only have $50, you can't afford to buy into that company. But if you use a platform that allows for fractional share purchases, you can buy $50 worth of a share in that company and get exposure to that company or asset class without having to have the full ticket. And so what Otis wants to do is take that kind of model and bring it to things like shoes. For example, I was talking to the co-founder and CEO, one of the two, Michael. And he was like, look, we have on the platform a shoe. I think he said that Michael Jordan wore when he like dunked a ball and like broke the rim. And there's like a piece of the rim, piece of like the backboard in the shoe. It's some sort of sports memorabilia thing that doesn't apply to me, but people are into it. You can buy a fractional share of that shoe on Otis. And if it appreciates, huzzah. If it doesn't, whatever. But it's another way to kind of put your money to work outside of just equities, or I guess cryptos are kind of standard now, I think. Does that make sense?
Yeah. I think that's helpful.
And as you're kind of describing that, it's reminding me a lot of like the conversations we had about people starting to get more comfortable in like alternative asset ownership.
Yeah.
It sounds like Public started by being like, we know you believe in like wanting an alternative type of asset, but what if we give you stocks in an alternative way, which I kind of really like rethinking not just like what people are investing in, but like how much of that thing that they're investing in, basically betting on like experimenting.
Yeah. And so Public will let you buy stocks. It'll let you buy crypto. And now with Otis, it's going to kind of bolt on this array of other stuff. So you can buy fractionalized NFTs and so forth. And there's a revenue side to this, because Public said, look, we're not going to take payment for order flow or PFOF revenues because we don't like the incentives there. And that was kind of okay. Like, it's hard to say no to revenue. You have to kind of fill that gap later on. And what Otis does is has kind of a transaction-based fee model, similar to like OpenSea or Coinbase. And so as people trade these alternative assets, money is generated. So if you take Otis's platform that makes some revenue, take Public's user base and go smush, in theory, there's some revenue there that's going to be exciting. We'll have to see how it kind of plays out though.
Yeah, I mean, a couple of things about this I think is really cool. I feel like, again, it's opening up accessibility, giving people who don't have a ton of money to invest a way to still invest, even with whatever they may have. Also, it's an M&A in the fintech space. And I feel like this is something we're going to be seeing a lot more of over the next year or two. Yep. Although Public didn't say how much they paid for it. I think you had a guess, right, Alex?
Yeah. I mean, look, it raised $16.5 million. They didn't disclose a sale price. So it's going to be between 40 and 80 million, probably weighted towards stock is my guess. Like I'm like my confidence interval, I'm just going to make it up 85%.
Okay, we'll take it. I mean, it's kind of cool to see like that consumers don't have to get like either they invest in stocks or either they invest in alternative assets. Like both is what happens when you have M&A. My like petty question is like, is Public early or late to doing something like this?
Yo, Public is a weird company, and it's not a diss. It's actually kind of a compliment, because if you were in Public's shoes and Robinhood scaling and getting a lot of stick at the time from Congress and users about PFOF revenues and that business model, which by the way took them all the way public, right? It hasn't gone so well since, but it did get them all the way there. And say no to that. We're going to focus more on community. We're going to focus more on creating a place where you can learn and then buy things versus kind of like trade, if you will.
Mhm.
It's bold, but it has put them in a spot where they are strong on the user side, and I would say trailing or catching up on the revenue
Yeah.
side.
I mean,
Okay.
is Yield Street already doing something like this? I think.
Probably.
I think so.
Yield Street?
Deal
I
Street?
think so.
Deal
If my
Street?
memories, if I'm recalling correctly, I think I
You're
wrote
the
about
fintech
it.
expert. So.
I wrote about a similar deal, and I believe it was Yield Street getting into something like this a few months ago, but don't hold me to that.
Well, I wouldn't be surprised. And here's why. And I know we need to move on to the better.com stuff, but like fractionalizing in general is becoming more popular. Like a lot of consumer fintechs will let you buy a piece of a share in a company. Like Amazon just announced a stock split. And the reason why is because their stock went up to like $2,000 a share. So that's becoming a thing. And also I think alternative assets are getting more popular. I think, the millennial kind of Zoomer crew are just more comfortable buying things that are non-traditional, just given that we haven't grown up with them per se, but I think we're just more in the mix, if you will. And so the combination of those two isn't a huge shock to see in the market. But let's pause from this funding round and M&A section, and let's talk about some themes. And Marianne, you're going to start because you're going to walk us into this one, but somehow better.com is back in the news. And how did we get here? Maybe is the right question to start with.
Okay. Well, I don't think it's a big shock that better.com had more layoffs, right? I mean, after the events of the past couple of months, for those who've been paying attention or those who haven't, this saga kind of all started in earnest early December when better.com laid off about 900 people or 9% of its workforce during a Zoom call. The way the CEO did it, Vishal Garg, was like condemned all over the world. The video went viral.
Which, like, wow, what a moment to be
Yeah.
in a tech CEO, have your layoffs go viral. What?
Right. I mean, like I said, they're not the first company to lay off people during a Zoom call, but I guess it was the way it was done. And then all sorts of things came out that some of it had been reported on, but just, Vishal's reported history of verbal abuse of his employees. Emails came out where he was insulting investors, lawsuits filed against him for all sorts of things, and just on and on and on. So he ended up taking a break where the company hired a crisis firm to help. We were all wondering, like, how does he still have a job? A month later, he comes back. He's still CEO.
A month-long break? What is this, an episode of Friends?
That's right. I feel like I do that.
Sorry to date myself there, but like I really do feel like this is a Ross and Rachel situation. Sorry, Marianne, back to you.
No. I'm just trying to, I don't want to overdo it with the history, but it's good context. So,
please handhold us.
During this whole time, like a bunch of people were resigning, ton of senior executives were resigning. Like the company's just like slowly sort of falling apart, to be honest. In the meantime, market conditions are getting worse. Better.com is a digital mortgage lender. It was really big on refinancings, which was really huge 2020, and then started to dip in 2021 as interest rates started to climb. So its business took a large hit. So with fewer people refinancing and also people struggling in general just to purchase with the higher interest rates, it's been suffering. And you combine that with the hit to its reputation that occurred in December, so its business hasn't been doing well. So I heard that it was going to lay off thousands of people this week, which, let me be clear, it is not fun as a reporter ever to cover layoffs. Like, it sucks. And we always feel like we don't enjoy it. Just, we enjoy getting scoops. We don't enjoy writing about people getting laid off, just to make that clear. I had heard about 4,000 and it ended up being just over 3,000 people. All right. So again, understandable market conditions, fucked up situation. You're going to have some layoffs. But what better.com did is manage to make it even worse because they sent severance checks out through their payroll app after midnight before anyone was even notified that they were being laid off, and then realized their mistake and then took them back. So
they took them back.
Oh yeah, until they announced it.
So that's where we're at today, basically.
Wow.
Yeah. So here's what I believe happened. I don't know for sure. So they were originally planning to lay off people on one day and then realized that had kind of leaked. So they moved it to like another day, but forgot to change that in the payroll system. So severance checks started going out too early. Now, for the employees who've already been through like hell and back, this was just like insult to injury. I had people emailing me, commenting on my LinkedIn post about how disgusted they were with how everything had been handled. They felt completely disrespected. It couldn't get much worse at better.com.
A SoftBank company.
A SoftBank company.
Throwing that in there because Marianne, they raised last April, May, somewhere in there.
Yeah, last year they raised about $500 million. I think it was. Was it all from SoftBank? I don't remember, but it was a big chunk was from SoftBank. Yeah. They were going to go public via SPAC. That's definitely on hold. I don't think going public will happen anytime soon for this company if it even manages to survive all this. And there are comparisons to WeWork, right? Another kind of prop tech or real estate tech company that was SoftBank backed with a very eccentric or controversial CEO. So there are definitely some parallels there.
Yeah. So like after reading your coverage literally for the past like few months, I at first was like, okay, we're seeing what we are seeing with a lot of like growth stage companies. Like they grew too fast, they have to scale back, blah, blah, blah. But now I'm at a spot where I feel like it's very different than just a growth stage company being a little too spendy. It's a company that, missed the correct business model, lost top talent, and has a shitty culture. And that feels a lot harder to recover from than a company that just had to have a heart-to-heart moment and really rebuild its processes. And I think that's kind of what's different about Better right now.
Think about Airbnb. Airbnb had a catastrophic start to COVID. They had to lay off a bunch of staff. And then they did it, I think, in pretty good format. Like they were super upfront about it. They paid a lot of money out. They were like, look, this is just what happened. Sorry. And it was generally not well received, but about as well received as it could be, which is, I think, indicative of what happened next to the company, which was strong performance, good execution, and a recovery, if you will. Because Natasha's right. They didn't have a completely shattered culture essentially surrounding one asshat who was the CEO. And it's amazing how culture does in fact matter at companies, shockingly enough. So
absolutely. Woof. I mean, who worked at better.com after the mess in December had any motivation, who had like any pride, honestly, anymore in their job? I would venture to say it's very few people. And it's a really sad situation. I feel terrible for those laid off. I hope they bounce back. We'll have to see what happens next with the company.
I always feel weird when I'm like trying to extract a lesson from layoffs. So I think like the tone you're striking, Marianne, is like spot on. But as I read your story, I was kind of like shook by the fact that like you can be a $6 billion company and still need to cut half of your staff or near half of your staff.
Look, I brought this up on the planning call. I'm going to bring it up again. How did they have so many people? If they're a digital technology company, how did they need like 10,000 humans around to do mortgage originations? Unless it wasn't a tech company and it was in fact a services shop with technology kind of like painted on the top. That's my contention.
Yeah. I mean, they had employees largely in the US and India, and a lot of them, were related to servicing loans, as you point out, and sales and customer service, that kind of thing. So I don't, when we talk about thousands and thousands of employees, it wasn't like all very, very high level positions, but yeah, still quite a lot. I think they were very ambitious in hiring and a little overly ambitious in what was going to happen in the future, short-sighted about the potential, like what was going to happen when interest rates went up.
Yeah. Well, I have their SPAC deck pulled up right here. And I'm just going to point out that for 2022, when the SPAC deck was put together, their estimated company revenue for the year was going to be $2.705 billion. So let's see how close they get.
Whoa.
The answer is going to be not very close.
Not at all.
Oh, Marianne, before we move on, there is another Better.com story on the happier note, which is what's going on with Glean AI. Can you give us just kind of a quick?
Yeah, I'll be
thumbnail?
quick. A former CFO, I think he left maybe a year and a half or two ago. He was also CFO at On Deck at one time. He realized, 10 years he'd been a CFO. He was like, we're doing this really wrong. Like he was like looking at spreadsheets. And at one point he said it took 3 weeks to identify $1.5 million in potential savings. And, it was just took too long. He noticed all sorts of things that could have been done better, like redundant subscriptions, paying for things that, like, say there was a trial and then you ended up not really needing it, but forgot to cancel the trial, all sorts of line items that people just quite frankly miss. And so he set about starting a company that uses AI to like automate this process, make it much faster, and help companies save money so they can spend it on other things like hiring more engineers or product development and things like that. So I think it's a cool concept. He definitely has experience, and he teamed up with someone with a strong background in data science, and they raised $10.8 million in combined pre-seed and seed funding.
Well, we'll see what we can understand from that company going forward, or
glean
from that.
But I guess moving on to our next section, we're going to talk about SPACs. Better.com had a SPAC delay, but that's not the first we're seeing happening in fintech these days. Alex, do you want to run us through the high level, and then let's unpack?
Yeah. I just want to point out that Ramp is also working on this idea of like saving money from people, eliminating duplicate subscriptions and so forth, which I think it just goes to show how far the SaaS economy has gone when many people are trying to save money on subscriptions. Just a data point. Okay, right. On the SPAC front, stuff has happened. So Acorns, which is no longer going public via SPAC, Marianne, that was announced back in January, I believe.
Right. Mm-hmm.
Yes. They put together an enormous new round. We'll get to that in a second. Mm-hmm. Also, Kin Insurance, another company that was supposed to go out via SPAC and no longer is, also raised some money. And so what we are seeing here, I think this matters, is that companies that were potentially going to go public via SPAC during the SPAC boom have pulled back from that because the SPAC result pool, if you will, is stagnant and covered in pond scum. And so they want to avoid that if at all possible. The good news is these companies are still backable, essentially. So Marianne, they're not running out of capital. They're just finding it from a different source. And Acorns at a price that we thought made a lot of sense.
Yeah, the company raised $300 million in a Series F round, valuing them at nearly $2 billion. TPG, a private equity firm, led the financing. They want to use it towards a lot of M&A. I think, to your point, Alex, they realize that it probably wouldn't be the smartest move right now to go public for two reasons via SPAC, because SPACs are not performing. Companies who've gone public via SPAC are pretty much not performing very well. So, and then B, they could raise money, a good amount of money, and still continue like pretty much at the same valuation they were planning to go public at. So they're still eyeing the public markets, but they want to do it via traditional IPO at some point.
Yes.
I have a theory on what's happening, and I have no proof on this theory other than like my cynicism. And it's that, like, you know how like we talked about this with like bankers leaking acquisition rumors, or bankers leaking like a company's plan to direct list. I wonder if these companies who are like, yeah, we're thinking about SPACs, are kind of giving that as like a signal that they are in the late stage capital raising market and are then raising money off of that. And the reason I think that is like, they all, it doesn't hurt to delay your SPAC. Obviously, they're raising lots of money on great valuations for it. So why not like say it really loudly, and then people will probably come knocking on your door saying, hey, don't SPAC yet, we'll give you capital. That's just like, I don't know. That's just a theory I have.
It could be with some companies. I mean, Noah Kerner, the Acorns CEO, was like, oh, we had a dry run at going public. I don't know if I would do that again, kind of insinuating that it was a pretty tough process to end up not going through the SPAC. SPAC going through with it. But, who knows what's really happening behind the scenes at other companies that have decided not to move forward with SPAC.
What I find disappointing is that when I read your story about Acorns, Marianne, was the dearth of data that they were willing to share, because we have their old SPAC deck. So I have tons of historical information. And then the moment they were going to raise privately again, they're like, yeah, we're not going to tell you anything. No news for you. No soup for you. And it's like, you can't put the toothpaste back in the tube. Like you almost went public. Tell me how you're doing.
It was pretty disappointing. I mean, he claimed they had beat revenue estimates for the year, but that's still not saying much. So I too was disappointed in not getting like more hard figures there.
Definitely. Alex, do you think that we're going to see startups stay private even longer now that SPACs are disappearing and the late stage market? Or I guess like companies were already staying private long when the public markets were fun. So now what?
Sorry, before you get into it, it just hit me. I mean, SPAC is now a 4-letter word, right?
Beautiful.
It always was. That's the thing. They were called blank check companies. They were trash cans because they took out the garbage. And then suddenly Chamath made them cool somehow, and everyone lost their mind and decided that somehow this was a new and improved way of doing business. And it turns out, no, it was just a trash can with a paint job. And so,
Right.
you can polish the turd, but it doesn't, change
So
substance.
apologies for interrupting. Natasha was asking you a question though.
No, I think that that's like an answer in and of itself, because that SPACs are not a thing anymore. But yeah, I don't know. I'm just thinking about like an early stage startup now. And I'm like, okay, you already had an opportunity to go public. Now that's even harder. So are we all going to be private forever and never get any data ever?
Well, we can't never get any data ever, because there are so many unicorns worth so many hundreds of billions of dollars that have to find an exit point. And the list is getting really small because the IPO window is effectively closed because markets are in free fall. The SPAC boom is kaput, and M&A has antitrust regulation looming over its shoulder. So what do you do? I guess you don't go public, but eventually you have to. There's going to come a point when the tensions in the private market will break, and they will have to find a way to exit these companies. I don't think anyone knows what to do. I don't think anyone knows what's coming. And when you talk to VCs about this, they kind of shrug their shoulders and go, well, our companies are fine. Yeah, well, whatever. The point is, Kin Insurance failed to go out via SPAC, or decided not to. They raised some money. Their public comps are garbage. So they're probably a year and a half, 2 years away. Acorns, probably a year and a half, 2 years away. I just, how long can this go on? I've been worried about this since 2016. So the answer is a long time, but certainly eventually we have to see some more IPOs. So I don't know when that happens, Natasha, but at some point.
Okay. I mean, I'll take it. I think that like the fact that the tension isn't disappearing is interesting and keeps definitely all of our jobs very exciting.
You know what I miss though? I miss waking up every morning, and before I did anything else, I sit it on the desk and I wouldn't even check podcast stats or web traffic. I would just go refresh the S1 feed from the SEC. And I would often get my assignment for the morning from the SEC when it, someone would file and I'd be like, stop the presses. I'm so excited. And I would get really hyped and go read all the data and like start to, just take notes. And it was great. And now I wake up and I check it and it's just like tumbleweeds going by. Nobody.
Right. The tumbleweeds.
Yeah. I miss the easy layup traffic because it was like, look, I'm human. I'm lazy. Now I have to think. It's terrible. Anyways, on that note, let's pivot to Africa. We have been tracking the African continent as a publication, I think, much more in the last 18 months and more so in the last 3 years than we have in our history. And it's not just because we are opening our lens a little bit, even though we are. It's also because African startups have been incredibly busy and they're putting up numbers that are eye-catching. And we just really are being pulled by the gravitational kind of weight and heft of these companies. Natasha, and there was some news about a new country having its first company in YC, I think.
Yeah. I mean, and it's hard at this point for anyone in startups to talk about Africa without mentioning our two reporters, which I love. Annie and Tej have been just doing such a great job on the beat. And her most recent piece is the root for our theme this week. So Annie basically uncovered that Uganda is now in the spotlight. After, for a long time, the startup ecosystem in Africa was really dominated by Nigeria, Kenya, South Africa, and Egypt. They still are the big four, but as she kind of uncovered in her story, the first Ugandan startup made it into the Y Combinator Accelerator, which sure is one data point, but it's more like we're seeing success being replicated across other countries. And that is such a healthy sign of, of success not being one off. And in Africa, it's always been like fintech in Kenya. And now it's other sectors everywhere. Okay.
To be clear though, fintech in Kenya has been popping off. So like that has been a key story to watch. And fintech has been kind of the constant theme, but I think we are seeing an increasing array of startups, though I think the one in, we talked about Dash recently, which was from Ghana. And I was going to bring it up as like this, like, oh my gosh, look, an African company raised a $33 million seed round, but it's fintech. And so I'm worried that now it's not cool because Natasha has thrown a bucket of cold water.
It's insane, Marianne, when you like remembering your reaction to that seed round during our prep meeting, I think reminded me of where we're at. Even though it's fintech, it's still like a $33 million seed.
I mean, my first thought was that all equity? Because like that's a lot of money for a seed round, even here in the US, but like much less an emerging market like Africa. So I was impressed by the number, I have to say. It was led by Insight Partners, which is, I believe, based in New York, and they're a private equity and venture capital firm. This is another example of where global investors or US investors are now like paying attention to their region in a way that they did not before. And very quickly back to Uganda, we didn't talk about another company called SafeBode, which became the first African startup to receive investment from the Google Fund in December. So, these are just, I guess like different signals of this market really just getting more interesting and compelling and attracting global investor interest, which is what I feel like where Latin America was about 4 or 5 years ago.
And now every other Latin American company is a unicorn. Like there are so many to count, but I feel like at this point, you probably don't even cover each of them when they hit that milestone.
Yeah, it's crazy. I think definitely there's, Africa it's growing like crazy, like Latin America did or has over the past few years. I love that we're seeing more diversity in terms of which countries are being the recipients of venture dollars. Definitely fintech is huge, but it's not just fintech, right? Like there's e-commerce. What are some of the other sectors that are attracting capital there?
Those are the two biggest ones to me, because I think about Jumia being a public tech company from Africa. They're kind of like the Amazon for Africa to some degree. They do kind of like payments tech and deliveries and logistics and e-commerce. And so they're kind of a broad thing. But I mean, thinking about where tech can have an enormous impact now, I think we are seeing e-commerce and fintech and also health tech. There's some startups working on delivery of medications and other similar things around. And so to me, we're taking like cool bits of tech, applying to a market that has less smartphone penetration and so forth. And it's having a robust impact. And that means human lives are improving, which is really the end result of what everything should be. If I can put on my human hat and take off my capitalist hat for a minute.
Yeah, it's like the promise of venture capital. So I think that we need to see more late stage VCs there for sure. Because while YC and Google are exciting, it's still, it's obvious, but like venture capital is nowhere near where it should be in Africa anyways. So I hope we see late stage actually set up roots there.
That is such a positive take on venture capital. Instead of refuting it with a rude and sarcastic joke, I'm just going to note that we are way over time and we have been told to shut up and go away. So we're going to do that. If you are listening to this on the podcast app on a Friday, in 2 weeks, we'll be back live. We're going to go now answer some questions and hang out with our friends on Hopin. We're also on Twitter Spaces and so forth. So swing by in 2 weeks. We do this every 2 weeks. I'm Alex. I have Natasha and Marianne with me, my absolute favorites. And we'll be back ASAP. Goodbye.
Bye.
Bye.
How do we do?
Oh, good. Very interesting conversation.
I'm still recording. Do you want me to stop recording or should we take the questions live or with the recording going on?
Let's take the questions with the recording just so we have it. And I'll keep recording. And do we want to start with some questions or do we want to start by announcing who won we should wait to announce who won the raffle.
Yeah, that kind of feels like
that'll be the cherry on top.
Yeah.
So we do have a couple of questions from Twitter. The folks are curious, do you think that the African startup scene will go the same direction as the LATAM market? And I know we started speaking to this a little bit and sort of drawing that comparison, but yeah, what do you see as the future of the African startup scene?
Marianne, I feel like this is your question, but I'm going to steal your thunder and go first. I think what we learned from the Latin American market is that you can take some models that have been proven out in other places and bring them pretty quickly to a market and accelerate them rapidly. For example, Nubank wasn't the first neobank, I don't think, but it certainly became one of the global powerhouses in that space. And so what I'm curious about and what I hope to see kind of stem from the analogy of Africa to Latin America is what giants are coming and then also when. Because Jumia, while it is public, it's struggling. It's super unprofitable. It's not growing that fast. It always seems almost ready to kind of take off. So let's put that aside. I want to know about the next giants. And I feel like in Latin America, we found those. So I want to know who they are in Africa. That's the thing that I'm most excited about.
I wouldn't be surprised if the same players that are now putting money in LATAM are going to be the same ones that will be putting money in Africa. And that includes Tiger Global. Andreessen Horowitz is increasingly investing in the region. I mean, just a lot QED. I mean, the list goes on and on. So I would hope that they're going to be smart enough to be looking at Africa. And I did an investor survey recently. Of course, it was focused on fintech, but more than one investor mentioned Africa. Another thing I'd like to point out that I think these two regions have in common, and it was actually a SoftBank executive that said this about Latin America, that tech or innovation in that region is more about inclusion than disruption. And I think that's true of Africa as well. So just yet another parallel, I think, between the two regions.
That's super interesting to hear. Yeah, it makes me think about too, like who is investing in those regions and the importance of like who those investors are.
Yeah, because if it's the same 6 people from Sand Hill Road that we've known for a long time, I'll be slightly disappointed. One can always hope for a new crop of investors for a new market, if that makes sense, especially more local, just to keep the wealth centered, if you will, versus having it exported to the Palo Alto real estate market, which is doing fine and doesn't need any help.
How much of that do you feel like we're seeing? Yeah.
I think I guess I think that when we see it more obviously, it will be another sign that the market there is maturing.
Yeah.
Just like the way that we're seeing institutional funds start to support emerging fund managers in the US and the UK. That feels like something you'd only do when you are so confident in like someone's ability to invest in the future of startups. And so I think we'll see that happen, but maybe not immediately. But listen, YC starts, people pay attention to YC when it does stuff. So that's always useful.
I think as the market emerges too, and more companies grow successful, and some of those founders move on and they do other things, whether that's start new companies, some of them become investors, right? Either angel or otherwise. So I think it's just going to take a little time, right? And hopefully we'll see more of that. I remember Tage wrote about one company that was like serving as kind of a business to help startups get off the ground there. So I feel I don't remember the name of it, but like efforts like that are increasing. So hopefully it's just a matter of time.
Yeah. Also, you should follow Tage. You should follow
Annie.
We have several Annies on the staff. We have several Annies and an Anna.
We'll link them in
we'll
our
link them in the
post.
show notes. And then also I would just say Manish over in India, who's just one of the best reporters I've ever seen. We also have K Park in the South Korean market. TechCrunch has a lot of folks around the world trying to keep eyes on the ground about what's happening, because even though, the US market and the European market are huge, they are certainly not the only place where we're seeing quote unquote innovation or capital deployed. So we're trying to have as broad a lens as we can, because everything's rather interesting. The downside is everything's happening at the same time. So it's like juggling an increasingly complex stuff.
Yeah, totally. And actually, Natasha, what you said kind of opens up another question that we got, which is, and I know we talked about this on a previous episode, but like thoughts on YC and also and also Google's Africa Investment Fund specifically, but I guess thoughts on YC as an indicator of international interest.
I think YC is going international because this is the only way to like really de-risk it from becoming irrelevant.
Mm-hmm.
Its batches are getting bigger. Some VCs, the ones that do still pay attention, use it as more of like, this is the direction the environment is heading versus these are the startups I must invest in. So I think it's super smart for them to be going more on the ground. I think like when their last in-person demo day, they had a huge focus on India, and they actually traveled to Bangalore and met startups there. And so I think the more that they can do there is like going to increase the longevity of YC as a brand. Like it's kind of like a FOMO strategy in a way. Like these funds are setting up shops in Africa, in India, so they don't miss out on deals. And so I think that you have to. It's not even like that, like it's smart, but it's like you kind of have to.
I also saw a headline today that Iconic hired their first European partner, and I was like, oh my gosh, welcome to 2012.
Wait, like, what? That's surprising.
I didn't say that on the show because I'm like only 90% sure about that. So it's not fully fact checked, but I'm pretty sure I saw that this morning. And I was like, oh my gosh, like that's not impressive at all.
No, that's not even news. That's like, I mean, that's news that I would hide because I would be embarrassed. Anyways.
Yeah, I would put that in the pocket quietly and then in 6 months tell people or something. But
we do have one last question. It's also on the African startup section, which I think has generated a lot of interest. Jonas is asking, how would you suggest African startups drive their solutions to be more disruptive rather than inclusive?
Is there so one, Jonas, good question, thank you. But also two, like, are those at tension with one another?
I don't think they're mutually exclusive.
Yeah, I think that's a good point. Yeah.
I think you can still be about inclusion, but you're disrupting. But like, I think the point he was trying to make was that it's not just about disruption, and it's also about inclusion, more so than you might see in wealthier countries or more developed, I guess, markets like the United States.
Also, like a point that I think you guys made through the show was like, it's to be like a pre-seed startup in Africa is different than being a pre-seed startup in a continent that's historically received decades of venture capital. So I think by nature of starting your company there, you are disruptive. And that's like not even me being cheesy. It's more like that, like you have to be disruptive in order to raise money there. The odds are even more against you.
Right.
So I think that'll happen really naturally. And from the inclusion perspective, I definitely think that just comes down to sector. But we talked about some cool strategies of companies going, doing websites, going over text instead of doing like overly digital channels that don't really reach the ideal clientele.
Yeah. I think think about EdTech. If you think about EdTech in a slightly less developed region, you're going to think about things like bringing more stuff to more people, which is cool, but it's also inherently inclusive. And so to me, the disruption probably comes hand in hand with the disruption, or I'm struggling to see a way to disrupt without it impacting lots of people. And ergo, it almost feels inherently inclusive. I may have overly teased that out.
No, I like that actually.
I agree with you.
Like
that's perfect.
Point.
Yeah.
All right, next Wednesday show.
Yeah.
I know. I was going to say that's perfect.
Speaking of which, do we want to say what we're talking about next Wednesday, Natasha?
I think we're still figuring out like exactly the angle we want to take. So, but you should always tune in. It's like our subject specific. We focus it on one topic, one question, and then unpack it. Everyone should.
Yeah.
And
we should
fun.
We should plug our last Wednesday show too.
Yeah. So during the fintech section, when we were talking about kind of like fintech M&A and if this is offensive or if fintechs are playing offense or defense, that was like all our Wednesday show was about 2 weeks ago or 1 week ago. So
it was just last week.
It was just last week. Oh my gosh.
Oh my gosh.
So if people are looking for like what to make of all the fintech M&A, which does include the Public and Otis conversation, that's a good episode to listen to.
Yeah. Also, Natasha leads those. If you're tired of my stupid voice, you can hear more of her every Wednesday on Equity on your favorite podcast app.
One more plug. I have a
please.
Fintech newsletter
coming
out March 27th. Subscribe, please. There's a newsletter section on our website and you can subscribe so it hits your inbox directly. Thank you.
What's it called?
That's not public yet.
It's called Marianne's Fintech Newsletter of Coolness. I just named it.
And while we're at it, Alex writes The Exchange. I write Startups Weekly. Follow us everywhere, guys.
We all wear many hats. But before we go, Grace, to whom are we giving the South by Southwest?
Well, let's get a drum roll before we announce it.
Oh my gosh, we have sound effects on the show?
Yeah, we do.
I was like,
I started doing that.
Woo! We are upping our production value.
Wow. I feel energized. We should do it before every show. Okay.
We should do it before. The winner of the ticket to South by Southwest is John Harney. We will get you an email with all of the information about how to redeem that ticket. Congratulations.
Congrats, John.
John, thanks for listening.
Okay, so cool. John, yay, John. Going back, we have live audio inputs that we can do sound effects while we're live?
Yeah.
Since when?
It's a new day. It's just the future from here on out.
Purpose. They were like, we're gonna like abuse that feature so much now. So everyone keep tuning in because
we're so easily pleased, right?
We can be like, go ahead.
No.
I was just imagining those radio shows where you like hear like a sound effect every 5 seconds, like wah, 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 like springs and stuff. I want to be one of those radio shows.
Oh, yes.
Can I get a Jim Cramer board for my setup so I can
That's
hit
what
buttons?
I'm talking about.
Yeah.
Definitely not.
Every time we say SPAC, I can play sad trombone.
Right.
Like this is going to be great. Ladies and gentlemen, you just got a taste of the future of equity because we are going to be using sound effects. But I think we can go. I think we're all set. Yeah.
Yeah.
Okay. Well, who is? This is Julio. And Yashad.
It's Julio.
So good.
He's having fun with this.
Behind the scenes is an entire staff of people that we should thank. Julio and Yashad are part of our video production crew. They actually make all this possible. They piped us over to your ears. And you can't see or hear them, but I will give them hugs and high fives for you because they are tremendous and we are lucky to have them. And I think with that, we can shut up and go away. So thanks, everyone. We're back in 2 weeks. Found is back next week. Cool. Bye.